Again, good afternoon. My name is Sam. I work as one of the financial advisors here. Joe is going to be off today. Special guest, we've got Tony Shink from Minneapolis Portfolio Management Group, MPMG. So he's going to give a little bit of a current market update and forward-looking analysis on what him and the folks at Minneapolis Portfolio Management Group think about things moving forward here. So jumping right in, we've always got the list of disclosures. Again, just need to inform everyone we're not attorneys. We can't give legal advice. Not tax advisors. We can't interpret tax law, but we are financial advisors. And of course, any investment are opinions on here. And then real quick, next week, we are going to be having our Q3 recap, Q4 market outlook with Nate Zeller, our Chief Investment Officer here. We're again going to be doing the live stream, but also if folks would like to come down to the office, we'll be opening it up to a limited amount of people and a nice free lunch on secured retirements as well. So if you'd like to sign up for that, you can after the webinar here today. So without further ado, I'm going to let Tony take over and give a portfolio update. Tony.
Great, Sam. Well, I appreciate the introduction and being invited, as always, to presenting and talking with everybody here. And look forward to some of the questions that might be coming forward. And thank you for investing part of your lunchtime to hear about Minneapolis Portfolio Management Group and our value strategy. I figured today we'd spend a little time on current market environment, how things are shaping up today and for the future a little bit of kind of what we're seeing out there and what MPMG is doing over the last quarter and how we're positioning ourselves to hopefully take advantage of some of the opportunities that we see coming around the corner. As many of you have likely heard, the data is coming in somewhat mixed when you start listening to the popular media, CNBC, Wall Street Journal, and all the different data points and areas that we get this information. If you look even just today, the market was a little soft to begin with as people are digesting the information from China, how their growth seems to be slowing down, especially over this last quarter. The investors in the market has the ability to forecast this issue like any issue going on forever. And if you have a negative spiral of discussions going on, you can tend to believe that the market is going to be kind of spiraling downward for a while, just as when everything looks positive and great, things kind of go the opposite direction, which is up. And from a rational standpoint, we know that neither one is necessarily true. We don't see trees growing to the heavens. At some point, things stop and change and slow down and move directions. So as we continue to see what's going on here in China, specifically causing this continued ongoing challenges of potential inflation, rising interest rates, supply chain challenges. Yes, what we see going on in China today and how that may temporarily impact supply chain and inflation. Yes, it likely has some inputs, but all in all, we don't think that long term that the slowdown is really going to squeeze corporate earnings, cause higher prices and less consumer buying going forward for the mid to long term. Occasionally, it's going to take a little while for us to kind of work through these supply chain issues, getting people back into the workforce as well as getting production and up and running again, getting our chips taken care of so we don't have a chip shortage when it comes to our computers, our cell phones, and our cars that are currently having challenges getting those products into them so we can actually go out and get these new toys, especially for the holiday season. It will happen. It's just taking a little bit longer than many people had anticipated. All in all, we are confident that the supply chain will work itself through. the issues that we have going on with our ports, the challenges that we have with trucking, all of those things are slowly getting worked out. And as long as we're patient, we should be okay. We add to all of this noise that's going on today with China. That just adds to more of the unpredictability that has been the media has been focusing on recently, with Washington, with the potential tax hikes, the debt ceiling issue, which has been kicked down the road for the next month or two, as well as the infrastructure bills. Those are all being talked about, creating more anxiety, which also brings more sleepless nights or a concern about earnings seasons, given the fact that several executives on popular media have recently been coming out with comments of maybe some weaker profits in some areas. Inflation numbers may cause the Fed to get a little more aggressive on their tapering, and potentially interest rate rises sometime in the near future. All of these things going on are legitimate concerns and need to be paid attention to, and are definitely causing sleepless nights for some in the near term. However, for much of the equity markets, in our opinion, it should stay relatively positive for the mid and long term. We continue to see Fed support, fiscal support going on. COVID vaccinations continue to roll out through our country. The Delta variant is likely past its peak. All of these things are very positive to our economy. We've seen a reduction in unemployment numbers. We have economic reflation, very positive things going on and going forward. September and October economic reports that the U.S. government has put out remain relatively positive. They have showed some slowing recently, but just because they're not up to expectations or estimates of some professionals out there does not mean that we are not on solid ground when it comes to manufacturing, new orders being placed, and strong retail sales. These are all really good positives going forward. Bottom line, data is solid and inflation remains high. But as long as it doesn't accelerate much further than what we've been currently seeing from an economic standpoint, all of this data should still be positive over the mid to long term for stocks. Our companies that we're investing in should benefit from these things. Specifically, we think that as this environment continues to move forward, it could be very well for cyclicals and traditional value type of investments. Now, if you remember from our previous conversations and market huddles that we've had, Minneapolis Portfolio Management Group, or MPMG, is an all-cap value equity manager. So really, there are two basic differences between investing in the markets. You have the growth idea and the value idea, or philosophies of investing. And I think it makes sense at this point just to give a quick rundown of the two differences. Growth type of investing are individuals and firms and institutions that are looking for companies that are showing or proposing a strong growth rate going forward, both on historical and projected basis. Growth type of stocks of companies are looking for strong return on equity compared to their industry in general. These type of growthy stock names are projecting their stock to grow and their business model and market position in the company to grow at a faster rate than the general economy, and oftentimes their industry as well. Now, value on the other side does not mean value stocks are cheap. It only means that their valuations or matrices are seen as attractive compared to the overall company itself. What I mean by matrices and valuations, as opposed to looking at the stock price, you're looking at low price to earnings ratios or price to book ratios, which is basically assets minus liabilities. Price to sales, how much is the stock trading compared to the company's sales that they're making or their cash flows. Another way to look at the difference between growth and value is I like to explain it this way, is that when you're looking at value, think of it as purchasing likely a pre-owned house that needs a little work with great potential in an established neighborhood, versus growth, which is you're basically paying more for a brand new house in hopefully an up and coming area. Excuse me. Now, when do these two investment ideas work well and do not work as well or perform not at market levels? When you take a look at growth investing or buying that brand new house in hopefully a great new area, in general, those growth type of stocks have the potential to perform better when interest rates are really low and falling and the company's earnings are rising. However, they might be the first to be punished when the economy is starting to cool and you start to see interest rates rise. Where value, on the other side, are stocks that often are in cyclical industries that may do well early in an economic recovery, but typically lag a little bit the general markets during the sustained long bull market. Now, if we look at today, what's going on? We've had a lot of discussion over the years about the FANGs, Facebook, Amazon, Netflix, Microsoft, Tesla, all of these cocktail hour stocks. Very exciting to talk about. However, if you look at today, over the last couple of quarters, the PE ratio of these technology type of companies, these social media stocks, are 36. Now, to give you an idea of where that is in comparison to like the S&P 500 or the general markets, historically, the PE of the market is closer to 17 to 20. So when you look at these great companies that have wonderful services and products, they're getting priced pretty frothy. You can almost say that they're priced towards perfection. Also, when you look at the capitalization, or if you take a look at purchasing all of the stock of all of the companies in the S&P 500, over 25% of that value, the capitalization or the size of the S&P 500, are going to basically those 6 technology, social media stocks of companies. In addition to that 25%, nearly 25% of the names in the S&P 500 are trading above 10 times sales. Now, I don't know personally any owner of a small business that wouldn't be willing to sell their company at 10 times sales. Again, everything that we're looking at today when you're talking about these sexy cocktail hour stocks, you're getting priced pretty highly. It makes us a little concerned because we haven't seen this type of valuation since the dot-com era right before the bubble burst. Not to saying that things aren't going to continue to grow and do well. It's just that several of these names that are getting all the attention today are priced for perfection. Whereas what we're looking for is what's going to be working around the corner. Where are the potential opportunities for our clients and our investors going forward? And what we have been doing is trying to see what names in our portfolio have done well, and let's try to sell or trim some of those names off to bring cash available for new ideas and interesting opportunities going forward. And over the last quarter, 3 or so months, we have seen several of our stocks do quite well. In manufacturing, we had companies like Parker Hannifin that we have trimmed down a little bit. Simon Properties Group, which is a real estate investment company that owns great properties throughout the country. That stock is doing quite well for our company clients, and we wanted to trim a little bit, take a little bit off the top there for some new ideas or opportunities around the corner. Also, United Healthcare Group, we trimmed slightly just to give us some cash as we go forward. We added to Las Vegas Sands, a gaming company, with the idea that as our economy continues to open up, people are wanting to go out and socialize. And Las Vegas Sands was weaker previously and is now starting to pick up a little steam. We've also picked up or added to our IBM as we continue to see little interesting opportunities with cloud and hybrid technology going forward, in FedEx as well as WestRock, two companies that we think are going to benefit as we go forward and with the reopening of our economy. One of the newest names that I'm very excited about in the portfolio should be a decent investment for clients. However, more interesting, I think, is the story that we have, and that is Pet IQ. Now, Pet IQ is a company that deals with our furry family members. As we look at what's happened over the last couple of years, we've seen a lot of adoptions take place for our furry friends into our homes, or the puppy pandemic, or pandemic puppies, I should say. And what we're seeing happening here is that as people were sheltered in place, they decided to adopt four-legged friends for their families. Now, what's interesting, now that these families have these new additions, these pets are going to be part of their families for the next 10 to 15 years. So if you think over the next 13 years that you're going to need to feed these new members of your family, you're going to need to make sure that they're healthy, bringing them to the vets. Pet IQ, which makes flea and tick collars, veterinary medicines for pets, both direct to the consumers as well as direct to the pet hospitals. They're also opening up almost like urgent cares, if you will, for our pets. New opportunities or venues for these new additions to our families. And I think that over the next market cycle, this type of investment, looking at where the economy is going, where people are focusing their family spending, should benefit from this activity. So we continue to look at these cyclicals, unique opportunities that were presented or opened up during the pandemic, and how we are going to be beneficiaries of this reopening. So we continue to look forward. We continue to be very excited about what is happening. And at this point, I'd like to see if there's any questions that I could answer for our portfolio, any of our holdings, or any questions that you might have as we go forward over the next several months into the end of the year. How's that, Sam?
Very good, very good. Thank you, Tony. And if you do have any questions, just type them in the chat here. One thing we've been hearing a lot, Tony, obviously, and if anyone's watching the news, inflation, right? I mean, it's out there almost every day. We had Social Security come with the largest cost of living adjustment in the last 40 years last week. Can you talk a little bit about what MPMG, how they view inflation, and how you guys are positioning the portfolio around that?
Great question. I'm glad you asked, Sam. When you take a look at inflation, we definitely see that happening. Our portfolio, we slightly rotated over the last year or so to areas that we think would be beneficiaries of inflation. Companies that have hard assets, businesses such as Simon Properties Group that owns premier real estate throughout the country. They own, not a great example, but they own Southdale as an example here. They also own the Galleria in Houston. They own the Short Hills Mall in New Jersey. So we think that here's a company that should benefit as inflation makes assets more expensive, and with all of their buildings that they have in premier locations, they're going to have very little I guess, competition because it's more expensive to build new venues. We also have Madison Square Garden in our portfolio. It owns Tao Hospitality. They own, of course, their namesake, Madison Square Garden. They have the Sphere. They have these great venues that as this economy opens up, people are going to want to enjoy entertainment, and we think that they're going to benefit. Walgreens Boots Alliance, or Walgreens, or local pharmacies. They have 10,000 locations throughout the U.S., 3,000 internationally. Again, these boxes are expensive to build, and they have a brand new CEO that we think is doing some really unique investment into that company that should benefit from inflation going forward. When you take a look at what we see right now with inflation and interest rates, this on a, I guess you could say on a negative standpoint, could hurt temporarily at least some of these companies that benefit from low interest rates. And we're trying to find businesses that are going to be beneficiaries. Bank Popular in our portfolio, a Puerto Rican bank. So as interest rates rise and inflation hits, that they should be able to increase their bottom line. I hope that answers your question.
Yeah, no, I think, thank you for the insight there. And Kurt, I think your question was around inflation, seeing some increase there. So with that being said, Tony, I don't think we have any more questions today. As always, we appreciate your insight. I'll reiterate, next week we'll of course have another live stream here with our Lunch and Learn. We do have a limited number of spots too. If folks want to come down to the office and see it in person, well, we'll treat you to a nice lunch as well. And then coming up on November 10th, we've also got our annual Veterans Recognition Lunch. So just saying thank you to all the military vets out there. And we'll have some more information on that in the coming weeks on how to get signed up. As always, we appreciate everyone's time today. If you have questions, if you'd like to sit down with us, one of our advisors, Tony here, please again, email us or give us a call, 952-460-3260. Tony, want to thank you again for joining us, and want to wish everyone a great Monday and a fantastic week ahead.
Sam, thanks again. Appreciate the opportunity and always the chance to chat with you and everybody else on the call.
Absolutely.
Thanks again.
We appreciate it, Tony. So have a good week, everyone.